Let's look at how inventory is impacted by errors. We've done a lot. Here we go. Oops. Exercise 811. In this problem, we're going to look at the impact of errors on the current ratio and the impact of errors on net income. So in number 1, before number 1, we have current assets of $370,000 and current liabilities of $200,000, and it includes the following 4 transactions. So if we figure out the current ratio before any of the error impacts, we see that we have a current ratio of 1.85. Well, let's see how that changes if we consider the errors. Number 1, we bought goods for $22,000 FOB shipping point on December 28th. We received and recorded the invoice on December 29th, meaning we debited inventory for $22,000. We credited accounts payable for $22,000. But the goods were not received until January 4th. Well, that's okay because it's FOB shipping point and the title to the goods passes when they're shipped on December 28th. So even though those goods are in transit, they would be included in our inventory and included in our payables. Thus, there is no error. The second one, though, is we bought goods for $15,000, but the terms were FOB destination, which means the title to the goods does not pass until we receive them. And we shouldn't really make an entry till we receive them. But we did. We made an entry when we received the invoice on December 31st, and so we debited on December 31st inventory $15,000 and credited accounts payable $15,000. That was an error, so we need to back out the $15,000 from our current assets and for inventory, and back out the $15,000 from our current liabilities, our accounts payable, because those should not be included until the goods are received on January 2nd. Number 3, goods held on consignment were included in the physical count. Well, consigned goods are not ours, so they should not be included in the physical count, so we need to back those out of current assets in inventory. And finally, number 4, freight in of $3,000 was debited to advertising expense. Well, it shouldn't go in advertising expense. It's a cost of the inventory, and so should be included in the inventory as any cost that you incur in order to get that inventory on the shelf and ready for sale. So add back the $3,000 to current assets. So recomputing this, I find that the numerator comes to a total of $345,000. Our denominator is now $185,000. And doing my math, it comes to 1.86. So not too much change in our current ratio. In Part C, we're going to look at the impact on net income. We said for number 1, there was no error, so there's no effect and there's no net income adjustment. In number 2, our purchases were too high, too big. And if our purchases are too big, then our cost of goods sold is too big, which means our net income is too small. So to correct it, we would add back the $15,000 as a net income adjustment. In number 3, goods held on consignment were included in the physical count, So ending inventory was too big. Thus, our cost of goods sold was too small, and our net income was too big, which means we need to reduce net income by that $13,000 error. In number 4, advertising expense was too big, and if advertising expense is too big, and we put it instead in freight in, which is an expense account, is too small. So if we shift these around, so advertising goes down and freight in goes up, it's a wash, and there is no adjustment. So the overall adjustment is we're going to increase net income by $2,000. Hope that made sense. We'll do one more error problem in just a second.